This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Well, greetings once again out there to everybody at TFMR. Hey, it is Monday, March the 4th, and not Thursday, March the 7th. We do actually have a Thursday conversation coming up this week. This is a midweek Thursday conversation, if you will. And it's a special presentation because I was able to track down today my old friend Ronni Stoeferle. And Ronnie, as many of you know, is an author. He's an analyst. He's a fund manager. And one of the primary authors of the great report called In Gold We Trust. It comes out every May. And it is always required reading for anybody that's interested in the precious metals. We're about 90 days away from that. And I thought, what a great opportunity to take some time right now to visit with Ronnie, see what he thinks about this year and where we're headed, and maybe get a little preview of this year's report. So, Ronnie, my friend, thank you for spending a few minutes with me.
Of course, anytime. Thank you very much for having me.
All right, let's just dive right in. I want to talk a little bit today about what I'm expecting this year and where I think this is all headed. But you and your group just actually put out something today that seems to kind of jibe with what I've been discussing, this idea that, central bank policies are reversing and what that means. I'm going to put a link to that new report here on this page so everybody can read it. But can you just take a second, Ronnie, and tell everybody about it?
Of course. That was our quarterly advisory board meeting, and we always have special guests. So Jim Rickards is a permanent member of our advisory board, and this time we had Trey Rake, who works for Sprott USA, who knows the gold market really, really well. And we had a discussion about the monetary Uturn, which is, from my point of view, really, really one of the most important drivers for gold. We once called this the emperor has no clothes moment, which is going to be the moment when the market realizes that this liquidity, let's call it liquidity happy hour that we have seen for the last 10 years, that the market is just addicted to this liquidity. And as you know, 2018 was the first year for 10 years that the biggest central banks actually reduced their balance sheets. Now we have seen the Federal Reserve reduce their balance sheet by 420 billion last year with their quantitative tightening. They're expected to reduce the balance sheet 600 billion this year and 600 billion the next year. But we can already see that this tightening of liquidity had enormous consequences on financial markets. And we have seen in the fourth quarter of 2018 enormous volatility, nervousness in the market, and of course central bankers had to react. And Mr. Powell, at first it seemed that he really doesn't care about the equity market, but now it seems that he's tied to the equity market, like everyone sitting at the Federal Reserve before him. So I think that this monetary U-turn that the Chinese already started in fall 2018. So they dramatically reduced their reserve requirements. They put in some fiscal stimulus. There will be more fiscal stimulus in the next couple of months. So they started with this monetary U-turn, and the Federal Reserve will continue with this U-turn. They basically started it in December 2018, and I think that, compared to a couple of weeks ago when everybody expected 3 to 4 rate hikes for 2019, we're far away from that now. The market is expecting actually lower rates, and I think that QT is also in question. So from my point of view, it's pretty obvious. At some point, there will be another round of quantitative easing. I don't know if it's going to be called quantitative easing, but the market is addicted to cheap money, and we have seen the consequences of some very minor tightening in Q4 2018, and of course central bankers reacted. And I think this is going to be really one of the biggest drivers for gold going forward.
Ronnie, before we go into the rest of this year and next, I just get your opinion of what has happened the last 2 weeks. I was telling everybody, it wasn't the safe haven bit as much that rallied gold in the, out of December into January because the stock market recovered. It was the gold beginning to understand exactly what you just mentioned, that this U-turn is coming. But now, just in the last 2 weeks, gold's down 5%, silver's down almost 10%. And is it just that the price got a little bit ahead of itself? What do you think is driving things lower? Because we've had a little slight uptick in interest rates. The dollar is basically flat. What is driving this current little sell-off?
Well, I mean, I would be a liar if I would say that I would have expected such a pullback or correction or whatever. I think that until like the week before, I think the technical picture really looked pretty strong. Mm-hmm. Gold wasn't affected by a stronger dollar, by a stronger equity markets. But I think the technical picture it weakened the last couple of days. I mean, if we put it into context, we have to say, in August 2018, we were trading at 1150, and then it basically went in a straight line up to 1340 on a daily close. So that was quite a big move. Now we have seen that the sentiment was pretty positive. We have seen, for example, the Kitco Gold Survey saw bullish retail investors, I think at 70 or 80%. This has come down now to 51%. Wall Street is only 31% bullish anymore. We have seen that mining stocks were extremely overbought, that the sentiment was very positive. Just as some sort of a sentiment gauge, I've had like interview requests like I haven't seen it in ages. So it clearly showed you that also the media picks up on gold again. So from my point of view, gold is taking a breather, but on a year-to-date basis, in dollar terms, gold is up now 1.5%. In Australian dollars, it's up 1%. In Swiss francs, it's up 3.2%. In euro terms, it's up 3.4%. So it's actually not that bad. What is encouraging from my point of view is the fact that, first of all, we're seeing that the relative strength of the mining sector is pretty convincing, I would say. We have seen that 71% of the gold bucks index and 81% of the GDXJ closed above the 200-day moving average a while ago. So this rally is also confirmed by the mining stocks. On the other hand, we can see that institutional investors, they are still kind of on the sideline. I talk to big investors quite a lot, pension funds, big wealth managers, high net worth individuals, and so on. And everybody, I think, has got gold on the radar screen because 2018 was a horrible year for every asset class. And of course, in the fourth quarter, gold was a pretty decent portfolio stabilizer. So it worked perfectly as a portfolio insurance. So I think that many people are on the sideline. They're eager to get into the trade, but everybody that I'm talking to still says, okay, we have to go above that 1360, 1380 resistance. Yeah. Then we'll go, then we'll invest in gold. Something that looks pretty encouraging for me is the fact that what my friend at Acting Man says. He calls it the canary in the gold mine. This is the South African Gold Index, the JSE. This is a pretty good early indicator for strength in the gold sector, and it perfectly confirmed its breakout. So that's a sign that I'm following. Then my friend Keith Weiner, he's putting out a fundamental gold price indicator, which is basically derived from the spread between gold futures and spot prices. And it's clearly showing that there's lots of physical demand in the gold space at the moment. And then another topic that also confirms kind of my currency war thesis is your beloved president, Donald Trump. He just came out with saying, I want a dollar that does great for our country, but not a dollar that's so strong that it makes it prohibitive for us to do business with other nations and take their business. I mean, he didn't mention Jay Powell in this quote, but then he said the US has a gentleman that likes raising interest rates in the Fed. We have a gentleman that loves quantitative tightening in the Fed. We have a gentleman that likes a very strong dollar in the Fed. So this is clearly a sign that there's even more pressure from the White House on the Federal Reserve. I think that Donald Trump is really becoming quite nervous again, because he needs and he wants a weak dollar. That's pretty obvious, and this should it might also be as some sort of he might be pushing the Chinese to sustain a stronger yuan as a part of the trade agreement. I think that's what I'm reading from it. So I think, in general, that the picture is pretty good. We have seen that the market, and this is basically basic Austrian business cycle theory, or our conviction that liquidity drives the market, and the market got too addicted to cheap liquidity. We have seen this confirmation in the fourth quarter 2018, and therefore I think it's out of question that central banks in the next couple of years will use measures that we probably cannot imagine at the moment. And the fact that everybody is talking about MMT now, I think that's a clear confirmation of my assumption.
Yeah, you can see where that's headed too. Ronnie, as an aside, it has been 7 years, but we're finally going to get the full implementation of the Basel III rules here at the end of this month, and everybody's got to adhere to them. We saw a big jump, the most central bank purchases of physical gold since, 1968 occurred last year.
Yeah.
Do you think that could be a fundamental driver as well?
Yeah, it could. We will write a chapter about that in our upcoming In Gold We Trust report.
Okay.
And that basically confirms that. I think this is also something that's really important for the message that we are communicating. For every investor, it just makes sense to hold a certain percentage of gold as a portfolio diversifier, as a stabilizer. So especially for institutional investors, it makes sense. And I think with those Basel III regulation kicking in soon, I think this will be another important step. And the fact that not only the Russian central bank, but also the Chinese central bank, the Turkish central bank, and so on, this so-called axis of gold, that they are permanently buying physical gold for their central banks. The fact that the repatriation, I think it was Romania the last time, that wants its gold back from London. I think we're clearly seeing that for big institutional players and central banks, gold is becoming much more important again. And this is also a consequence of some sort of a crumbling trust that we're seeing, and actually trust is going to be a very important topic and leitmotif of our upcoming In Gold We Trust report. And it's no coincidence that the report is called In Gold We Trust.
Right.
And you're seeing a lack of trust not only in politicians and the system, but also in financial institutions. it is a factor that is driving not only financial markets, but our society in general. So therefore, this is going to be a big topic that we will discuss in our upcoming gold report.
Well, and that was going to be the final question I had for you as well. Just a little bit of a preview of the direction that you're headed this year. It's a lengthy report, so I mean it's hard, I'm sure, to summarize it, especially if it's not even done yet. But I wanted to, I guess, see if it kind of jibes with what I've been saying, because I've been comparing this year and next to 2010 and 2011. In that, not that, the adage, Ronnie, about history doesn't repeat, but it rhymes, right? You've probably heard that one.
Yep.
In that this kind of rhymes a little bit. In that in early 2010, we'd had the first QE program, which actually began almost exactly 10 years ago, Ronnie. Can you believe that?
Yep.
It was in the middle of March 2009. And that was supposed to be a one-off. We're not monetizing the debt. No. Okay. And by the middle of 2010, there was all this talk about the green shoots of economic recovery. Remember that?
Yeah.
And the U.S. GDP was about 3%. And everybody, and it was, again, everything was supposedly going to normal, just like what they're trying to say now with hiking the Fed funds rate and QT. And then by the middle part of 2010, everything was demonstrably slowing. And by November of 2010, we had the QE2 announced. And then as you moved into 2011, there was all kinds of political discord and debt ceiling debates, and the U.S. was downgraded by S&P, and, the Swiss franc became the only remaining safe haven, and they had to peg that to the euro.
Yeah.
I can kind of see where events of this year and next end up kind of rhyming with all of that, and that's been kind of my central thesis. How does that jibe with what, or the direction you think In Gold We Trust is headed for this year?
Yeah, that's definitely an excellent analogy that you're making, and we have seen, as you rightly said, QE1 was, I think, December 2008 until spring 2010, and then we have seen the consequences of the end of QE. So they implemented QE2. Then in June 2011 it ended, and they implemented Operation Twist pretty much right away, and then started with QE3 in 2012. And we should not forget that gold was rising actually from 220 up to 1920 in a bit less than a decade.
Yeah.
So at the end of QE2, I think, or in between QE2 and Operation Twist, we have seen the all-time highs, and at the moment it is basically the opposite picture when it comes to the economy, because then everybody was talking about green shoots, and now everybody is talking about a soft landing, and I don't know if there is a bullshit bingo of financial terms. I think if I am allowed to say that, but
yes, you are. I love that term. I'm going to use that one.
Soft landing, that's just nonsense. It's great in theory, but it doesn't work. It's like the alcoholic going into the bar and saying, okay, I just have a small beer,
right.
And that's it, then I'm going back home. It just doesn't work that way. So from my point of view, of course it would be naive to believe that the next recession or the next crisis is completely the same like the last one, 2008. But of course, I think because a recession is nothing else than a reallocation of resources. That's it basically. But as we have delayed this reallocation of resources for quite a while with QE and with extremely low rates and so on, I think the next crisis will of course be more severe than 2008. And from my point of view, there's a lot of signs telling me that a recession is around the corner. Perhaps we're already in a recession, because the interesting thing, as you know, is that it's always diagnosed only a couple of months afterwards. So I think, for the In Gold We Trust report, we will make a new all-time high, because every year we try to write slightly less. and every year we just fail because there's just so much interesting topics to talk about.
Yeah.
And yeah, for this year's report, it's going to be published on 28th of May. So there are 84 days to go, and therefore the next couple of weeks will probably be pretty intense for me. But I'm really excited because the whole team and I, we really love what we're doing. We love researching, we love crunching the numbers, preparing charts, doing interviews, and so on. So it's going to be, I think, a very interesting report. We've got, for example, we've got a great chapter about gold bonds. We've got a chapter about the so-called, it's called Beschleunigungstheorie. Its English translation would probably be the acceleration theory, because normally when you ask people nowadays, how are you? Most people would say, probably like 9 out of 10 would say, I'm so busy, I'm so stressed out. Nobody says, yeah, I'm good. It's everything is pretty relaxed. And from our point of view, like many other things, one of the main drivers of this kind of feeling and zeitgeist that everything is becoming faster and a bit more stressful can be basically nailed down to our monetary system. So that's a bit of a philosophical topic. Then we will have an interview with Jim Rogers. We will have a great chapter about portfolio characteristics of gold, where we're gonna analyze in a very granular way how gold performs in different stages of a recession, because that's definitely a main outcome of our last In Gold We Trust report. Gold is one of the best portfolio diversifiers in the course of a recession. What else? Then we will also be doing an interview with Fofoa, friend of a friend of another.
Really? Okay.
Yeah, the free gold theory, something that is very interesting and that we've been aiming for quite a while. Of course, we will talk about the de-dollarization. We will talk about gold stocks. We will talk about the technical picture. I think it's going to be quite a read. And I don't know if you've got many Chinese listeners, but there will also be a Mandarin version of the In Gold We Trust report.
Idea.
So we've got an English, a German, and a Mandarin version of the In Gold We Trust report from now on.
That's a very good idea. I tell you what, Ronnie, yeah, it'll be, it's going to be an interesting year. No doubt about that. Next year as well. You've heard Powell reference every tool in the toolbox and that the balance sheet has tremendous ability to expand, that type of thing. He's already, letting the cat out of the bag in that regard.
Yeah.
I don't know where we're going to be by the end of May in terms of price, but I do know that it's going to be an interesting year, and that your report will certainly be a milestone. It will certainly be a must-read again for everyone in the sector. I know you'll be busy. You always have a multitude of interview requests around that time, but you can rest assured I'll be kind of nibbling at your ear a little bit, getting you to come back on here sometime in the days and weeks after it's released, because I'm sure there'll be a lot to discuss. And in the meantime, we'll post that thing from today so everybody can kind of get a little bit of a preview of where you're headed.
Of course, 28th of May is the big day. Afterwards, I'll be a bit exhausted, but we can have a long interview beginning of June. No problem at all, and I'm really looking forward.
I think it'll be a lot of fun, and it'll be very, like I said, it'll be very interesting to see where we are economically, central bank policy wise, price, all that stuff as this year unfolds. Well, Ronnie, thanks for the advanced look at In Gold We Trust 2019. I try not to work your fingers to the bone too much. I understand with winter almost over, your ski season's probably almost coming to an end, so you won't have any excuse but to spend more time in the office working, I suppose.
Exactly.
All right. Well, remember, all work and no play makes Ronnie a dull boy. So don't work too, make sure you get out and get some fresh air in the next 84 days.
No worries. Thank you very much.
All right, my friend. Thank you for everything, and we look forward to that report in May, and thanks to everybody for listening.